Hello, everyone, and welcome back to SALT Talks. My name is John Darcy. I'm the managing director of SALT, which is a global thought leadership forum and networking platform at the intersection of finance, technology, and public policy. SALT Talks are a digital interview series with leading investors, creators, and thinkers. And our goal on these talks is the same as our goal at our SALT conferences, which is to provide a window into the mind of subject matter experts, as well as provide a platform for what we think are big ideas that are shaping the future. And we're also excited to launch the SALT Crypto Show, which we've launched a few episodes here in 2022. And this episode will be part of that SALT Crypto Show series as well. And our guest is Asen Kostadinov. He's the Chief Strategy Officer at Copper. He joined the company from MMC Ventures, where he led blockchain crypto investment portfolio investing, and also led the fund's research department. Prior to his career in venture capital, he spent 4 years as an equity research analyst at Barclays, covering European media and video and internet gaming companies. Previously, Asen worked in the aerospace industry as an engineer in the Airbus Flight Physics Division after completing his engineering degree in Aeronautics and Astronautics. Asen is also a Chartered Financial Analyst, a CFA. So he has a wealth of experience across physics, crypto, as well as equity research and finance as well. So Asen, it's a pleasure to have you on. Again, very decorated background there. You're making me feel very unaccomplished in my own background, but excited to have you here.
Thanks very much, Tom. It's a pleasure to be here.
I want to start a little bit going into your personal background, because it is sort of a unique background to get into crypto, and you've had your hands in a lot of different industries and a lot of different spaces. What led you from being a flight physics engineer into being an equity research analyst? And then what was sort of your aha, or your eureka moment that led you to take all those skills and experience and bring it into the crypto world?
Absolutely. Great question. Basically, aerospace and engineering is a fascinating sort of discipline. Engineering is very useful to kind of understand things, problem solve from first principles. So it gives you a great tool set and framework to making sense of problems. The one thing I did miss while focusing heavily on the engineering side was actually making sense of the world. What was driving the world, geopolitics, the macroeconomy. As an engineer, you don't really have a lot of access to that. And the aha moment for me around this was, around the Euro crisis in 2010, 2011, 2012, when I was actually doing my work at Airbus. You could clearly see that some of the operations and commercial activity of Airbus was getting impacted by that. And, I had no tools to make sense of that. So that's when I kind of started developing interest for business and some of the underlying principles that are driving the world of economics. That's what led me to kind of join Barclays after my engineering degree. And, as most engineers do, they usually get into somewhat quantitative discipline in finance. And I actually joined in risk. And after spending a couple of years, finding my way through the world of banking, actually this idea of being a research analyst really, really appealed to me because it allows you to kind of take in information, start forming views and opinion, and basically, using arguments and again, first principles, develop opinions on how the world works. So that has then been kind of a forming part of my experience. The time I spent as an analyst. European media is an incredibly varied sector in terms of the business models that you employ and that you need to understand. It was going through a lot of disruption. The beginning of the 2010s were the time when Facebook was becoming prominent, Google, advertising models getting, upside down. You had incumbents that had to defend themselves. Obviously, the world of video gaming is incredibly dynamic as well. A lot of new technologies and business models get get first tested in video games, right? Nonetheless, crypto. And actually, it was around that time that I was exposed to crypto. In the beginning of the 2010s, I think I bumped into an article about Bitcoin, and like most people, the first sort of hurdle I had to go through is reading the paper, understanding what blockchain was all about. But at that time, I couldn't really apply to anything around me, so I kind of parked that for a while. And then I vividly remember around 2017, I was sitting on my desk, doing my usual analyst work, and you would see those Bloomberg headlines of companies, stating that they're now operating in crypto, or they were issuing tokens, and all of a sudden their share price would go up. It was reminiscent to a certain extent of the dot-com bubble. There was this particular IT company that I think changed their name to include blockchain or crypto, and then all of a sudden their shares popped up 700%. So I saw that side, and that was not a beautiful sight to see. And it was really during my VC days when I properly got into the space. Again, and as a research analyst would do, I would try to understand the technology, try to understand the different participants in the ecosystem, talk to a lot of companies while trying to form a thesis in terms of where the investment opportunities lie.
Right. And all that led you to Copper, which Copper, in my view, is one of the premier players in the space in terms of solving problems for institutions as it relates to digital assets. So, we run Salt, but we also have Skybridge, which is the asset management side of our house. And we became enthusiastic about crypto and digital assets in around 2017, like a lot of people, as prices started increasing. We started studying it more, and we're enthusiastic about allocating some of our funds towards digital assets. But there weren't a lot of custody solutions at that time that ticked all the boxes that we needed as an institution to go back to our clients and say with certainty, yes, we're investing in these assets and we feel very comfortable with the custody solutions and other infrastructure that's in place to protect them. So how did Copper go about attacking this problem? What's the novel approach that Copper takes to serving the needs of institutional investors into crypto?
Absolutely, very good question. When you look at crypto, clearly infrastructure is the number one thing that needs to be solved before mass adoption can occur. And when it comes to institutional infrastructure, back in 2017, 18, even beginning of 19, this was very nascent. Most of the providers, and as a VC, that's one of the great experiences and opportunities you have. You can speak to pretty much all the new young companies that are trying to disrupt the space. There were plenty of providers trying to pitch for that big opportunity. A lot of them, though, were approaching the problem purely from a technological and security standpoint. And don't get me wrong, I mean, it's technology, right? That's a table stakes thing that you need to have, expertise in technology. Security, of course, another crucial aspect. Nothing is worth anything of what we do here without the security aspect. But beyond all, we're still talking about an asset class, a market that is being formed. Therefore, paying attention to financial services and how the financial services industry operates, the regulatory frameworks, the legal frameworks that are involved, should be actually a top priority for everyone. And I think crypto in general has been on a bit of a journey, kind of realizing this, and we're definitely much further ahead compared to where we were, 2-3 years ago. But back to your question, I think what really differentiates Copper is that we take this financial services first approach to the industry, trying to create not just a technology product, but also a service that we provide to the buy side that would allow them to engage securely, compliantly with this new asset class.
And digging deeper into how Copper differentiates itself and approaches custody differently from some other institutional custodians, there's this idea of holding shards, and and separating out the different layers of security. Could you explain that? We have an audience that's a mix of crypto native people and also people that are learning more about the space. Could you talk a little bit more about that approach and why?
Yeah, absolutely.
Obviously Copper is deemed that it's the best approach to security?
Absolutely. So what you're referring there is the use of MPC technology, multi-party computation, which is really kind of the cutting edge of key management at the moment. And when I say key management, it's actually a bit of an oxymoron, because what MPC allows you to do is to remove the private key from the equation. So for most people that are familiar with crypto know that custodying crypto actually involves custodying a private key, because the private key in a blockchain context allows you to sign transactions so that you can move assets from A to B. With MPC, that private key gets pretty much destroyed upon creation, and essentially it gets substituted by shards. And these shards are used anytime you want to move assets or sign a transaction. In Copper's case, we use 3 shards, and to sign any transaction, you need 2 out of these 3 shards to actually sign the transaction. So why is that superior to some of the other approaches? Well, no matter how secure you can keep your private key, it is still a central point of failure. So it presents you with a big risk from the get-go. Eliminating that key and distributing it, decentralizing it to a certain extent, allows you to be more secure. But then it's also about how you manage these shards, right? Where do they live? Who handles them? How do you resolve edge situations when somebody loses their shard? And in our case, we keep one of the shards, we give another one to a client, to the client that is actually holding the assets with us, and a third shard is being kept with a trusted third party that is used for disaster recovery. So if something happens to Copper, then the client and the trusted third party can get access to the assets and move them safely to another wallet. Or if the client loses their shard, then Copper and the trusted third party can together recover the client's shard. And as with anything, it's a balance that you need to take between convenience of use and security. And at Copper, we've probably gone slightly more to the security edge, because we don't actually allow clients to easily self-recover shards if they lose some, because allowing that functionality could expose the client to other risks, as hackers getting access to their machines and all of a sudden getting access to assets. So we do involve a bit more operational actions in case that the client loses their shard, but that's all done with the best interest of the client in mind.
Right. And we always hear, about this stampede of institutional adoption that's coming to crypto. And that could mean institutions as in hedge funds and traditional asset managers. It could also mean institutions in the form of asset allocators like pensions, endowments, and family offices, sovereign wealth funds even. What are you guys observing in terms of, are those institutions moving into the space now, or are they sort of waiting for greater regulatory clarity in different parts of the world, including the United States and in the UK, where Copper is based? But what are you guys observing in terms of the momentum of institutional adoption?
Excellent question. And I think in order to kind of get a true picture, we should probably first define what we mean by an institution.
Right.
Because sometimes what crypto native people refer to as an institution is slightly different to what traditional finance people would understand. And to me, the real institutions are the big asset allocators, right? We're talking about the endowments, the pension funds, the large foundations. And then a level after them are the large asset managers, the Fidelities, the BlackRocks of this world. So if you consider those institutions, they're still somewhat on the sidelines, right? Some of them have started allocating to the space. All of them are considering their options, but you can't say that they're mass adopting the asset class at the moment. The large allocators are mostly coming into the asset via VCs, for example. There has been, widely reported cases of large university endowments allocating to, VCs that are actively targeting the crypto space. The activity at the moment within crypto is mostly led by the crypto native firms to a certain extent. These in most cases now are actually investment firms or hedge funds that have been founded by traditional people. There has been a lot of migration from talent from the traditional space to crypto, but they're still somewhat newer on the scene. Therefore, they have a lot more flexibility. What is deterring the very large asset allocators or asset managers to come into the space is, as you alluded to, regulation in the first place, and then also some of the quirkiness that exists within the market in crypto. So regulation is really the big elephant in the room. We are getting more and more clarity almost by the day. I mean, the executive order that we saw from the US president really helped in that manner. We are also seeing Europe being very active with, MiCA now expected to come in force in the next 6 to 9 months. Within the UK, there has been a lot of efforts in that direction to provide clarity. So things are moving, but we are not there yet, so that these large allocators can be comfortable accessing the class and the asset class and interacting with the underlying. Right. The second point on the market, well, the market structure in crypto is still very nascent when it comes to the institutions and institutional adoption. If you observe, in the traditional space, you have very complex but established value chains of market participants that are involved to ensure that the market is fair and that investor protection is in place. And the traditional market has also often been criticized for that because it increases the cost of operating in the market. Within crypto, we have the other extreme, which is almost the entire market is represented by exchanges, which tend to, act as liquidity providers. They tend to act as your financing providers. They also take care of custody, clearing, and settlement. And that is the other extreme, which is also not great because it gives rise to various conflicts of interest that need to be managed in a certain way. When a traditional sort of asset manager looks at crypto and the fact that they need to hold assets with large exchanges in order to facilitate trading, that is definitely giving them pause. Because these are not teams of just traders that are going after alpha. Right. They need to comply with the different regulations. They need to answer to their risk team, compliance departments, who are very sort of averse to operating in a market structure like the crypto market structure at the moment. So in time, we'll see that evolve. I don't think it will evolve to the same extent that we have in the traditional world. There are good reasons why blockchain provides you with a lot of opportunity to extract efficiencies, but we can't be operating at the extreme that we are today.
Right. Yeah, and our definitions of institutions are definitely the same because we come from the traditional finance world. But I think, as you described, people in the crypto world, when they talk about institutions, they're referring to a combination of the large asset allocators and the large asset managers. And certainly the allocators that we speak to, and it's reflected in the capital flows, like you mentioned. There's a big appetite to get into this industry and get into this sector, and they're accomplishing that by allocating to venture investments in the space. If you look at valuations of private companies, copper included, there's obviously been extremely bullish price action on valuations of private crypto companies. One of our theses at Skybridge is actually the tokens, because of the reticence from large institutions to allocate directly to a lot of these tokens prior to regulatory clarity. A lot of the money is instead flowed into private capital in the space. So it will be interesting to see whether the coin valuations start to play catch up with some of the momentum that we're seeing in private markets. But talking about some of these private companies, so we have a very close relationship with FTX as you may know, and look forward to having Copper represented at our Crypto Bahamas event that we're co-hosting with FTX in late April. But FTX and other companies have recently integrated Copper's ClearLoop technology. What makes ClearLoop framework unique from other trading tools that exist in the marketplace?
Absolutely. So as I mentioned, our primary sort of ambition is to provide the infrastructure that would allow this space to get institutionalized. And custody is the first point there.
Right.
The next one is actually resolving that market structure issues. And there is a very simple way to look at it, right? In traditional space, you have the concept of the life cycle of the trade. So you have pre-trade, i.e. various data analytics tools, risk management tools that allow you to determine how to trade. Then you have the trade execution, matching of trades and so on. And then you have the post-trade, which is all about settlement clearing. And what ClearLoop really is our ambition to represent or to take away the clearing and settlement from the execution, which happens on exchange. And it's essentially the first of its kind clearing and settlement network in crypto. It's the first kind of model of what a central clearing counterpart might look like in the crypto world. It allows you, as a client of Copper, to trade on exchanges while still keeping your collateral safe in cold storage at Copper. So it removes any counterparty risk that you might need to take with regards to exchange venues. And of course, FTX is one of the blue chip providers in the space, but we all know that there are various exchanges, the liquidity actually in the space is quite fragmented. So there is significant, especially from a traditional perspective, there is significant counterparty credit risk that an investor takes when they need to hold assets at exchanges. The other thing it allows you to do is actually to have more efficient movement of funds and allocation of funds, which improves your capital efficiency. So instead of you having to make on-chain transactions so that you can get assets to an exchange, you can dynamically delegate and undelegate assets to different venues at the speed of an API call at Copper. And last but not least, it's actually the fundamental infrastructure that we think will enable the space to move forward and offer, high-value services like prime brokerage in crypto in the right way. Something like ClearLoop will provide you with the ability to do things like cross-margining across different venues. And that is really going to bring a step change in terms of capital efficiency. Because at the moment, you might be getting leverage and margin on two different venues, but they don't know anything about what exposure you have on the other venue. So you need to margin these venues completely independently. When in fact, you might be doing activity that is correlated and inversely correlated. So in theory, your margin needs to be much lower than 2 times the margin at the venues. So the ambition behind this is really to move the space forward and to allow some of the traditional folks to come into the arena. And we know that this appeals to clients and to the buy side, because now we've been speaking not just with the crypto native firms, but a lot of the traditional institutions, very large ones, which are very excited to see a model like this develop in the space that will allow them to have a lot more flexibility. Right.
And speaking of some of those large institutions or corporations, it's very interesting to see the legacy banks and some of the legacy custodians go through and try to analyze how to compete within the crypto industry against companies like Copper and others in the space. And what you're seeing a lot of them do is collaborate with some of the more crypto native firms, including State Street, I believe, entered into a licensing agreement with Copper for some of your technology. How are you working with existing corporations and institutions who are looking to come up with their own solutions in an asset class and an industry that's obviously booming, but they might not have the expertise to come up with their own solutions. So what's been the process for you and the dialogue with Copper, working with people like State Street?
Yeah, great question. And look, the one thing that I didn't mention when we talked about institutions were actually the large banks, the large financial intermediaries. They were probably the last ones to properly engage with the space, and that started happening very quickly beginning of last year. My guess was why that happened was they actually saw a lot of demand coming from their buy-side clients. When you saw during the 2020, various high-profile asset managers or principals of asset management firms coming out and embracing Bitcoin as a possible asset class, that essentially spurred a lot of demand for some of the traditional asset managers to start allocating to the space. So naturally, they went to their large investment banks and asked, what can you offer in terms of products for us to engage with the space and get allocation? And of course, the banks they were a bit behind the curve, not because they're not equipped enough to deal with this issue. They were just hamstrung by, regulation or lack of clarity on what they are allowed and not allowed to do in the space. So the demand from the buy side, though, and some of these buy side firms pay hundreds of millions annually each to the big Wall Street banks. That was not something that banks and bank management could ignore. So everyone started moving very quickly, racing to be the first one to the market to actually offer a product. And I've never seen, I've worked at a large bank and I've never seen banks move so quickly. So to their credit, when they want to move quickly, they can actually put a lot of the bureaucracy to the side. And don't get me wrong, these are very smart, very capable people. They can definitely develop some of these things in-house. But given the large structures, the regulatory regimes they're operating under, they don't have the nimbleness to kind of experiment and iterate as quickly as a smaller sort of emerging provider can. Therefore, quick speed to market for them probably means partnering with best of breed technology providers. And we've been fortunate, as you said, to be one of the premier providers in the space. So it's natural that we see and we have a conversation with a lot of the players in the space. What was very interesting, about the State Street relationship was that from the get-go, it wasn't a conversation focusing just on things like Bitcoin and Ethereum, which are today's problem. It was much more focused on, we think this will be the technology that will underpin financial services going forward. And for us, this is a deeply strategic decision to be engaging and building for the future. So it's really refreshing to see, institutions thinking in that manner, because these are, multiple decade-old, hundreds of years old institutions.
Right.
And I'd say, it's really a partnership because, if you consider Copper as a custodian, we would never be looking to compete with some of these large institutions. They have all the relationships and everything to really get the clients on their side if they have the right technology. It's much more, how do you provide the right infrastructure so that they can get into the market in the best possible way and have the broadest access that they might require to satisfy their client needs. So the first thing, obviously, is getting the custodial infrastructure right. The next step of that is actually looking at things like Clearloop and how can Clearloop facilitate them to get in a safe way into the market. How can then they enable things like prime brokerage on top of Clearloop? So for us, again, it's about building the infrastructure, the ecosystem of providers so that we can facilitate this sort of institutional adoption or acceleration thereof.
Right. I want to switch gears a little bit, and these questions are less focused on your role at Copper necessarily, but it's fascinating to me that you came from, an equity analyst background where you were covering mainly media, video, internet gaming. And a lot of our friends in the industry, a lot of my friends in the industry are very bullish on how crypto and Web3 can power the next generation of gaming, including going back to FTX. They recently hired Amy Wu from Lightspeed Capital to run their new venture fund. She comes from a gaming background. They then hired Steve Sadin from Warner Brothers Games to run a specific gaming division within FTX. They're obviously extremely bullish on how gaming is going to, be powered by this new Web3 ecosystem that's building. What is your view coming from that gaming background and how, NFTs, Web3, blockchain is going to transform the gaming world?
Mm-hmm. Absolutely. And look, this technology and a lot of the innovations that we are seeing, they are going to explode in gaming at some point, right? I'm not giving any new insight here. It will take time though to get some of the underlying infrastructure developed, and also, to be honest, to regulate it in the right way. Because when you start talking about NFTs and other tokenized things, because anything these days can be tokenized, you're actually talking about the financialization of different aspects of our lives, and gaming being one of those. So there is a question about how do we regulate this? How do we protect people from getting hurt by these phenomena? So in terms of one of the issues within gaming has been interoperability, right? We've seen various marketplace models being developed where characters could be traded or gear could be traded. There have been always issues about how do you keep these markets honest, how do you protect again gamers. NFTs, in theory, and some of the token models can solve these problems very easily. But it all comes down to how do you put in place the necessary infrastructure in order to improve adoption. And you need to have as much openness in the ecosystem as possible. The good thing about gamers is that they tend to adopt things very easily. Basically, they are one of the early adopters of almost all new technologies. And therefore, there are a lot of experiments being run at the moment that I'm sure will lead to kind of fruitful efforts very, very soon.
Right. Going back to copper for a minute, you talk about how your goal as a company, whether it be from custody to trading, your goal is to create institutional infrastructure to take the industry forward. What does the future look like for copper? What things are on your radar as aspects of the financial industry generally, or of crypto, that can be further professionalized and institutionalized? What types of things are you guys working on?
Yeah, I think the bit that I mentioned about ClearLoop and basically taking that to the next level so it can be kind of a viable candidate as a CCP for the space is kind of number one thing on our radar. And as most things in financial markets, it's about having a very strong risk management capability in-house. And to be fair, some of the exchanges have been quite good at things like margining models and liquidation engines. I mean, FTX themselves are a leader in the space. But when you need to create that on a sort of market-wide level, you basically need a very, very strong capability. So without kind of going into the secret sauce, these are some of the things that we're planning. There are a lot of exciting things when it comes to getting more traditional adoption into the space. We're talking to a few very large kind of buy-side firms about ways in which they can get into the market. There are also conversations with large banks about them using some of our infrastructure to underpin not their custody technology, but other aspects of their business. So I don't really want to, and in certain cases I can't really share the details. But definitely in terms of train of thought and direction of travel, it's really getting the underlying infrastructure in place so that you can bring institutional adoption when it comes to crypto. The next stage of that, very kind of logically, is how do you continue or extrapolate the convergence of crypto and traditional finance? And of course, a lot of that will be achieved via tokenization of traditional securities or traditional assets. Once you have a good level of adoption in terms of crypto, what that does is almost it acts as a Trojan horse into the financial world, because large banks, large asset managers, they would now have the ability to interact and to operate on that infrastructure. So moving and tokenizing a traditional asset would not require such a big leap of faith, right? When you know how your back office, middle office needs to be structured, how your systems need to be structured to engage with these new types of assets, then it's pretty easy to see, what benefits this new infrastructure brings to you, and also how some of the traditional assets can be modified to actually live a tokenized life. So when you talk about the medium term, probably 2 to 5 years ahead, I think that will be the big thing that a lot of industry players will try to tackle, copper included.
Right. Last question is the question we've been asking every guest that we've had on Salt Talks and Salt Crypto Show is, geopolitically right now, obviously we're in a very tense time around the world with the Russia-Ukraine situation. Mm-hmm. Your company Copper is based in Europe. You're from Europe. And, to me, a lot of the events, ranging from the invasion to the sanctions that have stemmed from that invasion coming from the United States and other Western powers towards Russia, it sort of worked as an advertisement in a lot of ways for crypto and the value of non-sovereign currencies and digital assets and things like that. What's your view on how the situation that's occurring geopolitically is going to affect the perception and adoption of digital assets?
Yeah, I would agree with you that it's positive, I think, long term. However, in the short term, you have to look at everything from a kind of risk lens, right? And when the world is being turned upside down, anything that's seen as a risk asset tends to not perform extremely well. And whether we like it or not, crypto to a large extent, or large parts of crypto at the moment, they're seen as risk assets, right? I am all about, the different theses that people have about Bitcoin, for example, being a store of value, digital gold. I believe that may be true, but we're not going to see that unless we are at a mature state, right? When you have increasing adoption of an asset, it can't behave as a store of value necessarily, right? It will be inherently volatile. So I think it will be positive because, look, it's not just the Russia-Ukraine situation. You've had the COVID pandemic before that, and the whole macro world has been turned upside down. So there is no illusion anymore that we can keep the current sort of regime operating for much longer. I mean, we're seeing inflation kind of spiraling out of control than before Russia and Ukraine. Now that will be challenged further with the conflict. We're also seeing a new sort of spike of COVID within China, with whole regions being locked down. That will further drive inflation up. And all of that would just contribute and exacerbate some of the problems that were inherent already in the financial system. So that will all be positive, but there will be kind of short-term pain. So for anyone kind of engaged in the asset class, I think the mode that we should have is one of balance, and definitely forward thinking, so that we don't really overhype things and excessively take risks, which might leave us kind of naked in the short term.
Yeah, it's a great point about the evolution of Bitcoin. I think, like you alluded to, and actually our founder Anthony Scaramucci alluded to on CNBC the other day, is that right now Bitcoin is still in more of its it's an emergent technology. It's blockchain technology is still very new to the scene, and Bitcoin behaves more like a technology stock than it does like digital gold. Yeah, it's a startup. And then when it gets to saturation within the marketplace, when you have pensions and endowments and sovereign wealth funds and wider penetration, within the global population, then it might take on those characteristics of being, more akin to digital gold and being an inflation hedge and being a store of value. But right now it's much more a story of a technology startup, like you allude to. So I think that point is very well said. But Asen, it's been a pleasure to have you on Salt Talks. We've developed a great relationship with Copper. Very excited about collaborating with Copper on a number of different levels. And congratulations on all the growth and finding your way into crypto and Web3. We look forward to seeing you in person soon.
Thank you so much. It was great being here, John.
And thank you again, Asen. And thank you, everybody, for tuning in to today's Salt Talk with Asen Kostadinov from Copper. A reminder, if you missed any part of this episode, you can access it on our website at salt.org/talks or on our YouTube channel or podcast feed. Our YouTube channel is called SaltTube. We're also on social media. Twitter is where we're most active at Salt Conference, but we're also on LinkedIn, Instagram, and Facebook as well. And please spread the word about these Salt Talks. We love educating our community, some of whom are already in the crypto world and some of whom might still be skeptics, but we love educating people about the exciting companies that are being built in the space like Copper. But on behalf of Anthony and the entire Salt team, this is John Darcy signing off from Salt Talks for today. We hope to see you back here again soon.